Hi, so good morning. Good morning. How are you? How are you? How are you? All of you? How are you, Maureen? So for today, we are going to talk about the aspect of accounting for the associates and at the same time joint ventures, beside the subsidiaries which I did earlier. So good morning. Good morning. Beside the subsidiaries which I did earlier. So is that okay, Maureen? So is that okay, Maureen?
Yeah, I'm fine. I'm now on.
So that's okay. So it's all about, here we are going to talk about accounting for associates. We are talking about accounting for the associates, accounting for the associates and the joint ventures. So the accounting for the associates, and at the same time, I will be looking at joint ventures. So that is accounting for the associates, accounting for the associates, accounting for the associates and joint ventures, and the joint ventures. So accounting for the associates and joint ventures. So beside the subsidiaries, which I already did one question in our previous class. So when we talk about associates or associates and joint ventures, so associates, we will be talking according to international financial reportings, that is according to the relevant standards, at the same time joint ventures. So when we talk about associates, anyway, in short way, associates are companies acquired between the percentage of 20% to 49%. So the 20% to 49%. So these are companies acquired, and the percentage of controls rise between 20% and 49%. So associate company, the parent doesn't have control. Parent doesn't have control. The parent doesn't have control. The parent doesn't have control in this associate. But what does the parent have in associate? Significant influence. The parent has what we call significant influence. So we look at what is this? What is significant influence? What is this? Significant influence. And at the same time, we have to look at the accounting methods, how we are going to account the accounting method for associates. We call it equity method, which we call it the equity method, which we call the equity method. Which we call the equity method. So the accounting method is not about the equity method. And at the same time, there's exemptions to the use of this method, exemption to the use of equity method, exemptions to the use of equity method. So that is what you need to know about associates. And this is what I will be using to address more more of those informations I've mentioned about. So remember that here we have consolidation of joint arrangements and associates. So when we talk about associates, the associates, so are investing companies in which the parent company controls 20% of the shareholding, but not exceeding 49%. But not exceeding 49%. But not exceeding 49%. So then we look at, according to International Accounting Standards 28, and that is the relevant standard for accounting for associates. They should be consolidated for using the equity method. So what about this equity method? When we talk about the equity method, what does we mean? What do we mean by the equity method? It's the method of accounting for the associates, whereby they are initially measured at cost, adjusted with what? Post-acquisition profit or reserves, then you deduct the impairment loss. So since the control is less than 50%, I say that there is no control in associates, but there's what we call significant influence. So what is this significant influence? It's just the power of the parent to participate in the financial and operating processes of the associate company. So we have indicators of significant influence like participation in key decision making, that is by the parent, interchange of key managerial personnel, representation in the board, and the provision of essential information. Then since we have said that when accounting for the associates, the parent, that is the parent will use the equity method to account for the associates. But the scenarios whereby the parent is exempted to use this method. So when is the parent exempted to use the equity method? In the consolidation of the associates. So when the parent company is partly or wholly or fully owned by another company, when the shares of the parent are not trading in the market, or when the associate has been consolidated by another immediate company, or when the acquisition of the associate was meant to last for less than 12 months. Then we go to the joint arrangement, which is now according to IFRS 11. So we have types of joint arrangements, because a joint arrangement is whereby you find that one entity and another acquires another one up to equal percentage of 50%. So we have three types of joint arrangements. That is joint operations, ventures, and assets. So when we talk about joint operations, now we talk about the two parties having equal rights and obligations to the assets and liabilities of the entity they acquired. The parties are called joint operators. For the joint ventures, the parties will have equal rights to the net assets only. So for the joint assets, the two parties which acquired one entity 50-50, they contribute assets equally to the investments. So for accounting for these joint arrangements, we account the same way as associates. Joint arrangements are accounted the same way as associates. And when I'm doing the accounting, there is no difference between the joint operations assets or the joint ventures. So all of them, they are accounted the same way, and the same way we account for the associates using the equity method, whereby I said the equity method is whereby those companies are initially measured at cost, then we are tasked with the post-acquisition profit or reserve, then we deduct what? We deduct an impairment. So that is what you need to know, the introduction part of accounting for the associates or the joint ventures. Then now we can move to the illustration of May 2016, question 4. May 2016, question 4. May 2016, question 4. So May 2016, question 4, and this is the relevant sitting. May 2016, question 4. So they were saying that in this question number 4, what is provided here is that Jamii Limited is a listed company operating in the service industry. So during the year ended 30th April 2016, the company acquired two companies, that is Bora Limited and Njema, as part of the expansion plan. The foreign statement of comprehensive income relates to Jamii and 18 investee companies, Bora and Njema, for the year ended 30th April 2016. So there's Jamii, which had acquired two companies, Bora and Njema, as its expansion plan. So you are given the income statement for those three companies, that is for the parent itself, and the two investee companies, that is Bora and Njema. Additional information, you are told, on 1st May 2015, Jamii Limited acquired 80% of the 1,125 million ordinary shares of shillings 10 each in Bora for 18,000. As at that date, the share premium account of Bora had a balance of 3,750, while the retained profit was 3,705. Number two, on 1st November 2015, Jamii Limited acquired 50% of 600 million ordinary shares of shillings 10 each of Njema Limited for 6,300. As at that date, the share premium account of Njema had a balance of shillings 1,500. The retained profit as at 1st May 2015 was 2,085 shillings. The profit of Njema accrued evenly throughout the year. The investment should be accounted for using equity method. Number three, on the date of acquisition of Bora Limited, the property, plant, and equipment of the company had a fair value, which was in excess of the book value by 390, with the remaining useful life of 5 years. Number four, the fair value of net assets acquired in Njema approximated the book value as at the date of acquisition. Number five, during the year ended 30th April 2016, Bora Limited sold goods worth 6,000 to Jamii. Bora had marked up the goods by 25% above the cost. 1/4 of these goods were included in the closing inventory of Jamii Limited. The goodwill arising on acquisition of the investee companies had suffered impairment losses to the extent of 25% during the year ended 30th April 2016. The group's policy is to apply the partial goodwill method. So they need the students to compute for the goodwill for each of the investments, group statement of comprehensive income, and the group statement of changes in equity. So we start from that aspect of computing for the goodwill. So we compute the goodwill. So we compute for the goodwill. So remember that we are doing the question of May 2016. So this is a question of May 2016. So May 2016, question 4. So we start from the aspect of doing goodwill. So goodwill, we start with that of Bora. So remember that on this scenario, if even I go ahead to compute for the goodwill, remember that for this question, it was Jamii who acquired Bora, and they acquired Njema. So you acquired this Jamii up to which percentage? 80%. That is what you are told in additional information number 1, and this is 50%. So meaning that you have a subsidiary and at the same time a joint venture. So then now I can start from Bora, the goodwill of Bora. We know the goodwill of Bora is all about taking the purchase consideration minus what? Purchase consideration minus share of net assets. Share of net assets. acquired. So the share of net assets acquired. Share of net assets acquired. So purchase consideration minus share of net assets acquired. So for doing the goodwill of a subsidiary, remember these are subsidiary. You can either use full method or a partial. Full method or a partial method. Either can be applicable. Partial method. So that is when doing the goodwill of the subsidiary. But only you can use the full method if you are provided the fair value of the non-controlling interest. If the non-controlling interest is stated at its fair value, or if you are provided with the fair value of the ordinary shares of the subsidiary as at the time of acquisition of that relevant subsidiary, so that you can be able to determine the fair value of the non-controlling interest by taking the percentage of the NCI times the number of ordinary shares of that subsidiary, you multiply with the fair value. So it's either you are provided direct the fair value of the non-controlling interest, or you are told that the ordinary shares of the subsidiary as at the acquisition date, they were stated at market value. So being given the market price of the ordinary shares of the subsidiary as at the acquisition date, you can be able to arrive at the fair value of the non-controlling interest by taking the percentage of the non-controlling interest, multiply the number of ordinary shares of that subsidiary, then you multiply with the fair value provided. So in this question, looking at this question, there's no place where they provided the fair value of the non-controlling interest in Bora. But the examiner was a bit direct, because in the additional information number 6, he said that the goodwill arising on acquisition of the investee companies had suffered impairment losses to the extent of 25% during the year ended 30th April 2016. Then there is the last sentence in note 6, where he said the group's policy is to apply the partial goodwill method. So meaning that I will just be having one column whereby my goodwill, whereby the goodwill arising from Bona will be attributable to the parent company only. So here we can talk about purchase consideration. We will start with purchase consideration. That is the amount Jamia paid in the process of acquiring Bora. And this one is well provided in additional information number 1, whereby they said on 1st May 2015, Jamii Limited acquired 80% of 11.25 million ordinary shares of 10 each in Bora for 18,000, for 18,000, for 18,000. So our question is in millions, not thousands. This one I can write M, so it's in millions. Then we rest what? Share of net assets acquired. Share of net assets acquired. The share of net assets acquired. So the share of net assets acquired. So the share of net assets acquired, we start from the ordinary share capital as given in note 1, because now here we don't have the statement of financial position, so that we pick from the equity part. But these equity components are provided in the additional information. Remember, the equity components are the net assets, the aspect of ordinary share capital, share premium, revaluation reserve, retained earnings. Those are the net assets. So in note 1, remember they acquired how many shares? They acquired 11.25 million ordinary shares of shillings 10 each. So 11.25 of shillings 10 each, of shillings 10. So you multiply with which percentage? 80%. Then at the same in note 1, there's a sentence there. They said as at the date, as at that date, which is 1st May 2015, the share premium of Bora had a balance of 37.50. Share premium of Bora had a balance of 37.50. That is another one. While the retained profit was 37.05. Retained profit. While the retained profit, remember that the retained profit, it has to be as acquisition date. The figure must be as acquisition date, acquisition date. So of which that figure, in additional information number 1, they said while the retained profit was 37.05, that one was as at the date of acquisition, as at the time Bora was acquired, which is 1st May 2015. we have a retained profit of 3705. And finally, what we need to check here is all about revaluation reserve, the revaluation reserve, which must also be present as at the time of acquisition. So these and these, they have to be as at the time of acquisition. So the revaluation reserve, going to additional information on board. Number 3, go to additional information number 3. They said that on the date of acquisition of Bora, the property, plant, and equipment of the company had a fair value which was in excess of the book value by 390. So remember that I said revaluation is the difference between the fair value and the carrying amount of the asset. So they can test this in 3 ways. You can be given the fair value and the carrying amount. So you take the difference, of which obviously the fair value is higher than the carrying amount. So you can be provided this and this, you take the difference. You take the difference. Like now you are told the revaluation direct is 390. 390. So if they were to provide the fair value, let's say this one could have been like 1,000. So this could be 690. It could have been 690 or what? For us to have a difference of 390. 1,000 minus 390, this one could have 610, not 690. So 610. So if they were to provide the fair value and they provide the carrying amount, they could have provided this 1,000, this is 610, so that you have the 390 direct. So that is the first way. They provide the fair value and the carrying amount. This is an example I'm giving. Yeah? On this scenario, the revaluation gain was given direct because they say the fair value was in excess of the carrying amount. Which are the fair value in excess of the book value? A fair value in excess of the book value. The fair value was in excess of book value. In excess of book value by the 390. Or they can say, the third way they can test this is all about saying the book value was below the fair value by 390. Remember, book value and carrying amount is the same thing. So meaning that this is as at the date of acquisition. So 80% times 390, 80% times 390. So those are the equity components who are present. So we take 0.8 times 1125. So this is 9,000. Then 0.8 times 3750. This is 3,000. 0.8 times 3705. This is 2964. Then 0.8 times 390. This is 312. So the answer here could be, so that is 8,000 minus 9,000 minus 3,000 minus 2964 minus 312. 312. So this, I'm getting 2724 as my goodwill. As my goodwill. So the goodwill is 2724. Was it subjected to an impairment? So 25%, that is in note 6. They said that the goodwill arising is impaired by, remember that we have a goodwill of 2724. So they said that any goodwill which was arising from the investee company is impaired by 25%. So 25% of 2724. So 0.25 times the answer. So this is 681. So net goodwill will be, so our net goodwill will be, so 2724 minus answer. So this is 2043. Then we do the goodwill of the other company, that is Njema. Remember that for the joint venture, this is a joint venture. Obvious, you use the partial method. Obvious, when doing the goodwill of the joint venture or associate, you don't have to think which method to use. Obvious, it's partial method which is used. So we start with purchase consideration. Purchase consideration. So purchase consideration. So purchase consideration is all about, in addition information number 2, they said that this company was acquired on November 2015. So on 1st November 2015, Jamii acquired 80% of 600 million ordinary shares of shillings 10 each for 6,300. For 6,300. So we raised the net assets, share of net assets acquired. So the share of net assets acquired. We start with ordinary share capital. So the ordinary share capital which was there, the number of shares which were acquired is all about 600 of shillings 10 each times 50%. So this is 3,000. Then we continue reading the additional information number 2. They said, as at that date, the share premium account of Gemma had a balance of 1,500. So share premium is 1,500. This one will be 750. Then they said the retained profit as at 1st May was 2085. Retained profit. But now, will I use that one? No. I have to use the retained profit as at the time this company was acquired. Because our financial year ends when? Our financial year ends on 30th April 2016. That is the time our financial year is ending. 30th April 2016. Meaning that it starts on 1st May. It starts on 1st May. Our financial year starts on 1st May. It starts on 1st May 2015. 1st May 2015. 1st May 2015. So when was this company acquired? November 2015. That is when Gemma was acquired. So we need the retained earnings as at this date. The one which is provided is as at 1st May 2015, the 2085. That is what is given. But we need the retained earnings as at this time. So meaning that this period, how many months are those from May? These are 6 months. So 6 months. The first 6 months. So we need as at this time. So what we do here, we need to check the profit for the year from the income statement. Profit for the year. Profit for the year. So the profit for the year, if you go to the income statement, the column of Gemma, the profit after tax, that is the profit for the year. We have 1365. So how will you determine the profit as at this date? So you will take the 2085 plus the first 6 months. So this one will be prorated for the first 6 months, 1365. 1365. So 1365 divided by 2 plus 2085. So this one will be 2767. 2767.5. That is what to use as an acquisition date. So you will come and say 50% of that. 50% of 2767.5. So divide by, not divide by 10, 0.5. So this is 30, 83.75. So was there a revaluation? Was there a revaluation reserve? No, because in note 4 they say the fair value of the net assets, in GEM approximated the book value. So there was no difference between the fair value and the carrying amount for the assets of this company, for the net assets of GEM. Unlike Bora, where we had a difference of 390. You remember that? So be able to arrive at the goodwill of this company. We can be able to arrive at the goodwill we can be able to arrive at the goodwill by deducting our net assets from the purchase consideration. So we take 6,300 minus 3,000 minus 750 minus 1383.75. So this is 1166.25. 1166.25. So that is my goodwill. So then this one must be impaired as guided. So 25%. That is what you are told in note 6. Times 0.25, we get 291.5625. So we deduct for us to get net goodwill, for us to get our net goodwill here. So 1166.25 minus the answer. So this is 874.6875. Are we together up to that point for the one who is in the Zoom platform, Maureen? For the others who are following online, you can be able to.
Yes, we are together, Mwalimu.
Get up to that point for the one who is in. So that is how you are supposed to do the goodwill. So I can go and do the second part of the question. That is the statement of the profit and loss. Sorry, statement of profit and loss. So for the statement of profit and loss, that is the statement of the comprehensive income, the statement of comprehensive income. So what you do first, you have to check the time these companies were acquired, the time, so that when I will be consolidating the subsidiaries and at the same time joint ventures, I know if I need to take them into consideration for the entire year, were they present for the entire year, or they were present for a certain period of time, that is for some months. So our financial year ends on 30th April 2016. It starts on 1st May 2015. You know that the year, and it ends on April, it starts the next month, which is 1st May. But now, 1st May, the previous year. So when was Bora acquired? According to additional information number 1, Bora was acquired here. And the additional information number 2, Gemma was acquired on November 2015. November 2015. So Bora was there for the entire year. Bora, full year subsidiary, full year subsidiary. These are full year subsidiary. And when we talk about Gemma, Gemma was there for 6 months. It existed from here up to here. So 6 months, joint venture, 6 months, joint venture. And once you understand how to consolidate joint ventures, this is the same way we consolidate associates. So joint ventures and associates will be consolidated the same way. So once you understand about this, that is how you are supposed to do associates. Even if they bring an associate, the same way I will consolidate joint ventures is the same way you consolidate associates. So you come here and say, Jamii Limited, because it's the one who is consolidating the other companies. So they need a group statement of comprehensive income, group statement of comprehensive income. The group statement of comprehensive income. It's a group statement of comprehensive income for which period? That is for the year. For the year ending, our financial was ending on 30th April 2016. For the year ended 30th April 2016. So looking at the statement provided there, but this is a question of May 2016. May 2016 question 4 for the guys joining. May 2016 question 4. So we start with revenue. So for the revenue, when consolidating, the parent will take the figure of itself plus that of the subsidiary. We don't add joint ventures. we don't add joint ventures. So for the joint ventures, in the income statement, we consider some few items, which I will mention as we move forward. So you add the parent plus subsidiaries. So I can see that the parent figure was 102, 180 plus 52, 800, 52, 800. So under the revenue, the only item to deduct, the only item to be adjusted, or the item to be removed here is all about if there was intergroup sales between the parent and subsidiary. That one is not supposed to be considered as a revenue. So you deduct the intergroup sales. So in addition, information number 5, remember there was those goods which were sold from Bora to Jamii at a price of 6,000. That is what you deduct. The intergroup sales between parent and subsidiaries only, and if they took place in the current year, under consideration. If they took place in the previous years, you don't have to deduct. You only deduct if they took place in the current year, under consideration. That's all. We will be able to arrive at the answer there later. You will give me the answer. Then we go to the cost of sales. So for the cost of sales, you do the same, parent plus subsidiaries. So that is 76, 635 plus what? Plus 36, 990. You deduct these 6,000, the intergroup sales, which is deducted under the revenue. Then after that, after deducting that one, what is done next? After deducting that 6,000, so you add the UPS and realized profit on stock, on the closing stock, because out of the goods which were sold from Bora to Jamii, remember they were sold at a profit. So did the Jamii resell all of the goods? So no. Checking in the additional information number 5, you can see you were told that Bora had marked up so just a minute. So I was saying that on this scenario, according to note 6, when Bora sold goods to Jamii for 6,000 at a profit of 25%, 25% above cost, 25% above the cost. He included the 25% above the cost. Jamii receiving them by the end of the year, end of year. Jamii has not sold all the goods. 1/4 of these goods were included in the closing inventory. 1/4 of these goods were still in the closing inventory of this company, meaning that that is what is unsold. So the UPS is all about the unsold goods, which is 1/4 of the 6,000 times the profit margin. Remember that 25% above the cost, this is like which fraction? This is 1/4, but this is a markup above the cost. So we need to change to margin. So we need to change the 1/4 to margin. So that one will be 1/4 plus 1. You add the numerator to the denominator. That one will be 1/5. So this is all about, so the answer will be 6,000 divided by 20. This one will be 300. That is what you add here. So if there was again UPS on opening stock, that is due to the goods which were sold in the previous year. If there's a transaction which took place in the previous year, some goods which were sold by one entity to the other, by a parent to the subsidiary or subsidiary to the parent in the previous year, then the other company which received those goods never resold them. Never resold all the goods by the end of that previous year. Remember that we could be computing the UPS, but the one by the end of the previous year. which will be an opening for the current year. That one is deducted here, but we don't have something of that kind. Another thing to adjust here is depreciation, undercharge, and overcharge. So undercharge arises due to revaluation. Remember, there was a revaluation of 390. So you divide with the remaining useful life. You divide with the remaining useful life. And that is well catered for in note 5, of which you were given 5 years. The remaining useful life. So the revaluation was 390. You remember I talked about this 390. The difference between the fair value and the carrying amount. So 390 divided by 5, you get 78. You get your 78. So that is the depreciation undercharge, which arises due to revaluation. So depreciation undercharge, this one is added here. If there was overcharge, we could have deducted. So undercharge arises, undercharge arises due to revaluation. Depreciation overcharge will arise due to sale of fixed asset. That is after computed for the unrealized profit on fixed asset. You remember I did an introduction, a comprehensive introduction on the same. So once you have time, you can recap on the video for the introduction. It's present in my YouTube channel. So you get the gross profit. If you deduct this, if you deduct the cost of sales from revenue, then we go to investment income. Investment income. So investment income, you add the parent plus subsidiary, which is 584 plus 60. So if there was dividends paid by all the investee companies, you deduct minus share of dividends paid by all the investee companies. That is both Bora and GEM. That is the first point where I could have considered GEM if they paid dividends, if there's any dividends paid by all the investee companies. In this question, I could have deducted from the investment income because that one could have been included in 584. So then after that, we talk about operating expenses. Operating expenses. So the operating expenses are which expenses? Distribution. We have distribution expenses. So the distribution expense.
Hello, Edwin.
Yes.
Let me on the investment income. We don't put the investment for. Oh, Gemma is dash. What about? I'm asking, what about where do we put investment in the joint venture?
No, we don't add the joint ventures here. What we could have deducted is the dividends which were paid by those joint ventures. We don't add, we don't sum the parent plus subsidiary plus joint venture. No, we don't add items of joint ventures. What I could have deducted here is only the dividends which could have been paid by those joint ventures under the subsidies, because the parent could have received that as income, which is wrong. So he could have recorded them here under his income. That is why I have said you deduct what could have been paid from those companies, including what the joint venture could have paid, because the parent could have considered that as an income. So that is the case.
All right, thank you.
So now the impairment, again, you consider both. This is the first point you consider, if dividends. Second, where you consider all the companies under impairment. So impairment of the subsidiary was, do you have the notes? Have you been making short notes? Maureen.
Yes, I do.
The impairment for Bora. How many devices are you using? Because I can hear the echo once you're on mute.
I'm only using my laptop. There's an echo.
When there's an echo. Anyway, I'm asking about the impairment. Impairment of Bora?
The goodwill impairment was for Bora was 681.
681. And for
Njema
Hmm.
is 291.5625.
291 point?
56.
So up to this point, you will be able to remember that the operating expenses I have talked about distribution, admin, then I have introduced impairment. So the impairment is what you introduce from what you did in goodwill. That is an expense. So I've said the first point whereby you consider all the companies under investment. I said if there is any dividends they paid, no matter subsidiaries, venture, or even if there's associates, if there's dividends they paid and that one is provided in the income statement, what the value of the dividends they paid you deduct based on the share the parent controls them. The second point you consider all the companies is under impairment. You can see I have considered both Bora and Njema, so that here you get your profit before interest and tax. Before interest and tax. Mute your mic, Maureen.
All right, Eden. So there's a question I did, but I'd placed, so we are not supposed to place depreciation. The depreciation that we realized when the undercharge, we don't put it under operating expenses.
The question was saying what? You don't have
The question was saying when the valuation, sorry?
You go ahead.
When the valuation was done, there was depreciation undercharge.
That one is
so that's why I'm saying we don't put it under operating expenses.
It's adjusted under the cost of sales. It's adjusted under the cost of sales. All right. So after getting this profit before interest and tax, now we talk about the interest, which is the finance cost. Our finance cost was interest. Our finance cost. It was 720 and 600. Then after that, we have to introduce now Njema. So we come here and say share of profit after tax in Njema. What the parent is taking from that company as an income, profit after tax in Njema. So remember that after this company has paid tax, what is remaining with, what it will be remaining with, what Njema would be remaining with, the parent take 50% as income. So 50% of the profit after tax, 50% of 1365. This one comes to the parent as an income. Then now you say profit before tax. I have not considered the tax of parent and subsidiary. So income tax of the parent and subsidiary, which is 1530 and 11 what? 11, so that you say profit after tax, profit after tax. After that, you say profit attributable to NCI. Before profit attributable to NCI, you can see there was other comprehensive income to be added here. Add other comprehensive incomes. According to the question, remember you go with the flow of the question. So other comprehensive income. So the revaluation of intangible assets. So the revaluation of intangible assets is, as provided there, is 530. 530. So that you get total comprehensive income. So that now you share the profit attributable to minority interest. Profit attributable to NCI. And the profit attributable to parent. So what you have realized is the joint ventures are just considered thrice. If they paid dividends, the impairment is considered, then the profit, which is attributable to the parent, based on their profit after tax. That is the same way. If you have associates, that is the only 3 areas you consider your associates in the income statement. Then in the statement of financial position, they are just considered once. You account for them. So you get the net investments to be taken to the non-current assets. And I said you account for them using the equity method. Initially cost, add the share post-acquisition reserve, you raise the impairment loss. So what we are supposed to do, let's get the figures for these. 102, 180 plus 52,800 minus 6,000, minus 6,000. So this is 148, 980. Then the next one is 76, 635 plus 36, 990 minus 6,000 plus 300 plus 78. So this is 108,003. So if I will deduct this from my revenue, so 148,980 minus answer, I will be able to get a gross profit of 40,997. And 584 plus 60, 644, 644. 12,810 plus 7260, 20,070. Then 77 plus 4815. So this is 12,594. Then 681 plus 291.56. This is 972.56. These are deductions. So 40,997 plus 644 minus 20,070 minus 12,594 minus 972.56. You get which figure? 644, 49,997, 20,070. So this is 8,004. Or I'm wrong. Anyway, I will confirm. So 720 plus 600, 1320. These are deduction. Then 0.5. But remember, this one was not there. This one was present for many months, 6. See, the joint was existing with the parent for 6 months because it was acquired on November. So meaning that it was not present for the full year. So this profit will only accrue for the last 6 months when it was present. So this is 341.25. So if I take 8004 minus 1320 plus 341.25. So are we together? Are we together? Are we together? Or there's a mistake we have done? Is the additions correct? You can confirm.
Yes, they are correct.
So this was 0.44. Then minus 1320 plus 341.25. This one is 7025.69. So 1530 plus 1125. This is 2655. So 7025.69 minus the answer. So this is 4370.69 plus 530. This is 4900.69. Confirm if there's anywhere I've not added word, you let me know.
The addition is it's correct, eh?
Yes.
Yes. The addition is okay.
Any question then before we continue?
No question.
No question.
No, okay. Just a minute. For joint, you said joint ventures and associates. When we are making the income statement, we consider them in 3 occasions or 2. You said 3 dividends, a dividends, then the share of profits after tax. Then the other one is where?
See, under investment income, if they pay dividends, if even remember that year, even if they we might a share of dividends paid, no matter who paid, subsidiaries, associates, or just if they are present, you deduct, because those dividends they paid, the parent could have recorded them under investment income as the income he received. But remember, the parent is attributable to what companies like now joint venture is attributable to his share of profit after tax. So we don't, the parent is not supposed to record dividends he received from those companies as income. So which he had already recorded as income. That is why we are deducting at this point. The next point is all about impairment. Impairment of all those companies you have to consider. No matter subsidiaries, associates, or joint ventures, you have to put them into consideration. Then this is the third point. You can see after the finance cost, then as income from those invested companies.
Okay. Understood.
Understood. That is well understood. So so we continue. We continue with other. So there is an issue here, by the way, because I have seen. So this one is 148,980. If you minus this with 108,003, that is why I was doubting this answer. This is 7, not 9. This is 7. That is why I have been asking. Is there an additional problem? You are not seeing that. There's a deviation of 20 in our answer, in short. But everything is correct. Everything is correct. It's only that now, the only thing you could have not even if yes, this is just during marking, they could have not marked the total. So they mark entries, so the total doesn't have any problem. Even if your total is you make a mistake, a short mistake in terms of answers from your calculator. Remember, totals are never marked. The mark entries. $84.44 minus 1320 plus 341.25. This one is 7005. 0.69 and minus 2655. This is 4350 plus 30, 4880. So this is 4880.69. Then after that, now you continue with the determination of the profit attributable to NCI. But we need to do our working on that. The profit attributable to NCI, then we get the one attributable to the parent. So profit attributable to NCI, so we consider the profit after tax in subsidiary. So because the subsidiary is where we have the NCI. So the profit after tax in Bora. So which was the profit after tax in Bora? 2070. So before we share 20% of this to the minority shareholders, we need to adjust this profit. It might be overstated or understated. So I will adjust this profit by lessing UPS, if sales, upstream. Was there a sale upstream? Yes, according to note 5, Bora sold goods to Jamii. The UPS was? Our UPS was? We arrived at 300. Because now, Bora had sold goods to Jamii. So who realized the profit? Who realized the profit? Bora. But Jamii never realized this profit of 300, meaning that the profit of Bora, which is this one, 2070, is overstated by 300. Another thing which is deducted is depreciation under charge. Depreciation under charge. Then we add overcharge. So there was depreciation undercharge, by the way. If there was depreciation undercharge, remember that if we did a depreciation undercharge due to the revaluation, remember we had overstated the profit. So we need to minus the depreciation undercharge of 78. Then overcharge we deduct. Overcharge we add back, sorry. Undercharge we deduct because our profit was overstated. Overcharge we add back, because our profit was understated. We need to adjust. Then we raise what? Impairment. You can only less impairment loss if we use the full method in goodwill. Because if you use full method, that is whereby you find that at least the minority shareholders contributed to the total goodwill, which was subjected to an impairment. Here we use the partial method. So we cannot include that impairment here. So this is 1692. So that is adjusted profit. So then you multiply with 20% now. 1692 times 20%. That is how you get your profit. So 338.2. 0.4, sorry. 338.4. So that is what you put here. 338.4. Then now you take 4880.69 minus 338.4, so that you get what is attributable to the parent, 4542.28. So that is how you get the relevant marks for this question. So, but now remember, I have said the mark. And make sure you are in.
Hello, Ade.
Are you using YouTube at the same time?
No, I'm only using
Zoom.
Yeah. So I don't know why I'm not able to see the whole screen.
To do what?
I'm not able to see down here. Let me see.
Maximize your screen.
If I put full screen. Let me see, hide. Still, I'm not seeing it down there.
What are you not seeing?
So so after the adjusted profit, now you say profit to NCI. Oh, sorry. I'd taken 80% instead of 20. I've seen it. Times 20. Three 38.4. Okay, so put attributable to NCI 33 G.
It's okay, yeah? So this is what is supposed to be done. That is what you do. So, and remember that during an exam, they mark entries. They mark entries, and mostly you find that they give you 1 mark for 1 correct entry, or they can go ahead to give you 2 marks for any correct entry. Like now we have 1, 2, 3, 4, 5, 6, 7, 8, 9. These are total, it's never marked. So this one, this one, this and this. So these are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So these are statement of comprehensive income. They were in need of how many marks? They were in need of 12 marks. And these are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So meaning that this one, they could have given you 1 mark for every 1 entry. Or they decide to say that any 6 correct entries, they multiply by 2. Mostly in the last 2 previous sittings, when they were marking your papers, they have been giving you 2 marks for every correct entry. So you don't have to score everything to score the 6. That is to score the 12 marks. You don't have to score everything to score the 12 marks. If you have 6 correct entries, like now if it was last sitting, if you have the 6 correct entries, like a question of this kind, you could have scored the 12. Then the last part of this question is all about the statement of changes in equity. The statement of changes in equity. The statement of changes in equity. You have the statement of changes in equity. So for the statement of changes in equity, so we have Jamii Limited. So the group statement of changes in equity. Group statement of changes in equity. Group statement of changes in equity. So that is for the year. So for the year ended 30th April 2016. So for 30th April 2016. So for the statement of changes in equity, the group statement of changes in equity, here we consider only the retained earnings, the profit, retained profit. So we start with the retained profit balance brought down, retained earnings, balance brought down. So that is for Jamii, Bora, Njema. Then you add profits for the year, that of the parent, the one which was attributable to parent. This one, it was 542.28. Then you raise dividends paid by the parent, if there was any dividends paid by the parent. We don't have dividends paid by the parent. These companies were acquired during the year under consideration. So their retained earnings balance brought down will be 0 if the investee companies are acquired under the year under consideration. If they are acquired in the present year under consideration, you can never have the balance brought down. Acquired during the year under consideration. Acquired during the year under consideration. So then what about Jamii? This one is not provided. So meaning that
Right, Edwin. So this one was Bora was acquired at the start of the period.
yes, we cannot have a balance brought down because what's the balance brought down? The profit they retained from the previous year. Was it there? Was it present in the previous year?
Oh no.
So that is it. We are done with the question. May 2016, question 4. It was having 20 marks. That is how you consolidate for the joint ventures and subsidiaries. And at the same time, I said, once you understand how you deal with joint ventures, that is the same way you are supposed to deal with That is the same way you are supposed to deal with associates. That is the same way you deal with associates. So without forgetting the YouTube guys, the one who always follow this platform online, you have the option of joining in the Zoom classes. You call this number and you join. Some of you have joined and I expect more to join. You know my number, 254-28-760-546. Do the necessary, we do more. We have an evening class and this one during the day. So the evening class is on Wednesday and Thursday, 8 p.m. to 10 p.m. For the daytime, I think we do, like now we'll be doing from today up to Friday. We have done for today's class. We have a class tomorrow, Thursday, and Friday. So tomorrow we do another question, which has a statement of financial position, at least, so that you know how you deal with associates and joint ventures when we have a statement of financial position. And I think Thursday we wind up the topic by doing maybe another question. Then Friday I introduce cash flows. Or you have already done cash flows. I think you requested for the same.
Yeah. I had already done cash flows. I joined one of the evening classes.
That is good. If you are done cash flows, we go to published. We have not done. We have done published. No.
Not yet.
So we move to the published financial statements. Remember, cash flow is part of published. So if you have already done cash flow, so what I will be doing in the published is all about the preparations of the statement of profit and loss and statement of financial position. Some 3 to 4 questions.